For the next module, Module 16, Income Tax Schemes, Accounting Periods, Accounting Methods, and Reporting. Income tax schemes are legal rules and plans enacted by the government under income tax laws to establish how income is taxed, how much tax is owed, and how taxpayers can minimize their tax burden through exemptions, deductions, refunds, or special tax arrangements. Purpose of different tax schemes are: 1. To generate revenue for the government. Income tax is a major source of funds. Revenue is used for public services like education, healthcare, defense, and infrastructure. 2. To provide tax relief to taxpayers. Schemes offer deductions, exemptions, and rebates. This reduces the tax burden on individuals and businesses. 3. To encourage savings and investments. Certain schemes promote long-term savings, retirement planning, insurance, and investments. This helps strengthen the economy. 4. To promote economic growth. Lower taxes or incentives for businesses, startups, industries. Encourages investment and job creation. 5. To ensure fairness and equity. Progressive tax schemes ensure higher income, higher tax, lower income, lower tax. Promotes social justice. 6. To simplify tax compliance. Some schemes are designed to reduce paperwork, make tax calculation easier, improve voluntary compliance. 7. To support social welfare goals. Tax benefits may be given for education, health expenses, donations to charities. Helps achieve social development objectives. Types of taxation schemes and their scope. 1. Graduated income tax. Scope: individuals, employees, professionals, sole proprietors. Tax rate increases as income increases. Progressive system. Used for compensation income, business/professional income, if not opting for 8%. 2. 8% income tax rate, optional. Scope: self-employed individuals and professionals. Gross sales/receipts not exceeding 3 million Cuban pesos, VAT threshold. Features: 8% tax on gross sales/receipts exceeding 250,000 Cuban pesos, in lieu of percentage tax and graduated income tax. 3. Percentage tax, non-VAT. Scope: businesses with annual gross sales/receipts below 3 million Cuban pesos, not VAT registered. Rate: generally 3% of gross quarterly sales/receipts. 4. Value-added tax, VAT. Scope: businesses with gross annual sales/receipts exceeding 3 million Cuban pesos. Voluntary VAT registration allowed. Rate: 12% of gross sales/receipts. 5. Final tax. Scope: passive income, interest, royalties, dividends, prizes, etc. Examples: 20% on bank interest, 10% on royalties, books, musical works. Tax is withheld at source and no longer included in income tax return. 6. Capital gains tax. Scope: sale of shares not traded in stock exchange. Sale of real property classified as capital asset. Rates: 6% real property, 15% shares not publicly traded. 7. Corporate income tax. Scope: domestic corporations, resident foreign corporations. Rate: 20% or 25% depending on net taxable income and total assets. Concept of accounting and its types. An accounting period simply means the reporting time frame of a business. It is the period covered by financial statements such as income statement, balance sheet, cash flow statement, It is usually 12 months, but may also be shorter, monthly or quarterly. Types of accounting period: calendar year and fiscal year. 1. Calendar year. A 12-month accounting period that starts on January 1st and ends on December 31st. Example: January 1st, 2026 to December 31st, 2026. Who commonly uses it? Individuals, small businesses, many companies for tax purposes. 2. Fiscal year. A 12-month accounting period that does not start on January 1st. Example: April 1st, 2026 to March 31st, 2027. Who commonly uses it? Corporations, schools and universities, government agencies, businesses with seasonal operations. Accounting methods and reporting. Cash basis method. The what you see is what you get approach. The cash basis method records income when cash is received and expenses when cash is paid. Pros: extremely simple to track, excellent for managing real-time cash flow. Cons: doesn't always show the true long-term health of a business if you have large unpaid bills or pending invoices. Best for sole proprietors, freelancers, and small businesses with no inventory. 2. Accrual basis method. The accrual basis method records income when it is earned and expenses when they are incurred, regardless of when cash is received or paid. The logic: if you finish a project in December 2025 but don't get paid until January 2026, you still report that income on your 2025 taxes. Pros: provides a much more accurate picture of profitability over time. Cons: you might owe taxes on money you haven't actually received yet. Best for larger corporations and businesses that maintain inventory. 3. Hybrid method. The hybrid method combines both cash and accrual methods. A common example is a business using the accrual method for inventory to track goods sold, but the cash method for all other income and expenses like rent or utilities. Note: the IRS and most global tax authorities generally requires consistency. You can't flip-flop between methods mid-year just to lower your tax bill. 4. Importance of income reporting. Income reporting is important because it ensures compliance with tax laws, helps determine the correct amount of tax to pay, provides accurate financial information for decision-making, builds credibility with investors, creditors, and government agencies, prevents penalties and legal issues. 5. Filing and reporting taxable income. When it's time to file, your chosen method determines your taxable income, which is calculated as gross income minus allowable deductions equals taxable income. Key reporting reminders. Deadlines. Missing filing dates usually results in immediate penalties and interest. Documentation. Keep receipts, invoices, and bank statements for at least 3 to 7 years, depending on your local laws. Forms. In the U.S., this usually involves Schedule C for individuals/small businesses or Form 1120 for corporations. Thank you so much for listening to today's business law and taxation lesson.